This video data is as of August 8th, Thursday. Howdy, swings. As we predicted in yesterday's video, low jobless claims were released before the open, and this was favorable for the markets. As expected, the market rallied strongly to the S&P 500 5330, but from there it consolidated and ultimately failed to break through the low and closed lower at 5319. Is this the start of a rally, or is a double dip still a concern? Let's take a look at Fullhapce daily swing market forecast. Swing trader's friend, Fullhapce Intelligence presents today's Wall Street market forecast for August 8th. Here is daily market move. S&P 500, 5,319.29, 2.3% up. Dow Jones, 39,446.82, 1.76% up. Nasdaq, 16,660.02, 2.87% up. Russell 2000, 2088.6, 2.09% up. Phil Semicon, 4,730.01, 6.86% up. VIX Index, 24.13, minus 13.36% down. Here is the daily sector performance. The market had a good day on Thursday, with many sectors showing gains. Notable improvements were seen in capital goods, semiconductors, healthcare, power producers, asset managers, autos, consumer goods, and travel/leisure. Consumer staples, traditional media, real estate investment trusts, REITs, some areas of healthcare, and utilities showed signs of weakness. Here are the reasons. Stocks saw a significant rebound after a drop in weekly jobless claims eased some recession concerns from last Friday's report. The better employment outlook didn't change expectations for a rate cut on September 18th, and investors are anticipating cautious actions from upcoming Federal Reserve meetings. The market is more stable now, but recent declines have left some investors cautious and less confident. There were many earnings reports on Thursday, mostly from smaller companies, and the results were mixed. There are no major events for the rest of this week, but geopolitical issues and the Consumer Price Index report next week are areas to watch. Here are things to consider. A single jobs report may not be enough to gauge the overall employment situation, and the situation appears to be headed in a potentially negative direction. Rising Treasury yields could be detrimental to stocks. Recent earnings reports have shown weak sales and guidance from some companies, suggesting consumers are cutting back on spending. Travel and leisure also appear to be seeing weak demand. Industrial stocks have reported disappointing results amid high interest rates and economic uncertainty. Many small-cap tech companies have issued weak outlooks. Geopolitical conditions remain highly uncertain, with potential major conflicts involving Iran, Hezbollah, and Ukraine. Here is the daily market forecast for swings. The market is currently at 5,350, the resistance level set by Fullhapce for the S&P 500 index, at the same time at the turning point between a rally and a downtrend. In a similar situation, yesterday we predicted a rally in the market, but today we are leaning a little more towards the downtrend. A second market pullback may be attempted on Friday, which may lead to a double dip phase for the following reasons. Today, the market once again moved quickly to the 5350 resistance level, but failed to go over it again. Resistance of this magnitude is likely to drag the market down. As a result, we may see the market move lower or sideways until CPI comes out. In the worst-case scenario, the S&P 500 could fall to around 5150. In that case, even if the market potential is strong, the rally may not come as we wait for good CPI results. Here are some additional insights. Markets now appear more stable, with less extreme sentiment than before. Upcoming economic reports, such as the CPI, FOMC minutes, and Powell's Jackson Hole speech, are expected to be less aggressive. The economy appears to have entered a new phase with slowing growth and fewer new jobs. Companies have held on by cutting costs, but there is still a risk of earnings declining. Stock valuations remain high. Here is devil's advocate. The opposite scenario is that the market will continue to rise and surpass the S&P 500 400, which means a rally has begun. In this case, investors can participate in the rally while maintaining their existing positions. The rationale for this scenario is as follows. Weekly jobless claims fell slightly, providing some relief to investors concerned about employment. The Federal Open Market Committee, FOMC, meeting on September 18th, the July Consumer Price Index, CPI, FOMC minutes, and Chairman Powell's Jackson Hole speech are likely to be favorable for the market. Several small and mid-sized U.S. technology companies also reported good earnings and provided positive guidance. Tokyo Electron, a major semiconductor company, reported good earnings and an optimistic outlook for demand for artificial intelligence. The world's largest private equity funds have about $720 billion in unused capital, according to Bloomberg. The recent drop in bond yields has pushed mortgage rates to their lowest since March 2023. While there is merit to the opposition scenario, we believe it is unlikely to materialize, as it is mostly based on what was known before last week's market crash. Nevertheless, viewers should pay attention to the concerns raised by the opposing scenario. Here is the conclusion. With such strong resistance, it's unclear whether it will be broken or not. As the market rises, anxiety increases, so the market might fall tomorrow. In this case, even if the market's upside potential is strong, the rally may be delayed until a good CPI result comes out. Until then, the market may fall or move sideways. In this kind of bear market, it may be wise to buy low for short-term gains. The bottom line is that traders may be wise to consider both our main forecast and opposition scenarios to manage risk effectively. Thank you for watching Fullhapce Intelligence, the best investment partner for swing traders.